Most day traders don't lose their money in one dramatic, screen-smashing blow-up that they can point to later. Instead, they lose it. Slowly, quietly, in a dozen small ways they never actually see happening. The dream sold to them is simple, seductive, and it fits neatly onto a single phone screen. Quit the boring 9-to-5, beat the market from a laptop, and let the charts quietly pay the rent. It is a genuinely intoxicating pitch, and millions of Americans have now quietly given it a real try. The apps are slick, the fees look like zero, and the whole thing feels a lot like a video game. But underneath that friendly, gamified surface sits a machine engineered to separate ordinary people from their money. The data on what really happens to these traders is some of the most brutal in all of finance. A landmark study out of Brazil tracked nearly every single person who started day trading its futures market. Of the ones who stuck with it for more than 300 trading days, 97% lost money. Only about 1% of them ever earned more than their country's minimum wage from all that effort. And the researchers found something even more haunting, buried deep inside those thousands of blown-up accounts. There was no evidence at all that anyone actually got better the longer they kept trading. Think about what that finding really means for a moment, because it is genuinely staggering to sit with. In almost any other field, steady practice makes a person measurably and reliably better over time. But in day trading, 3 full years of daily effort left the typical person no closer to winning. So here is the real story that the trading gurus on social media will never put in a highlight reel. Day trading is not really a skill game that a determined person can simply grind their way into beating. It behaves far more like a casino, except the house edge here is almost completely invisible. In a casino, at least the flashing lights and the free drinks warn a person that the odds are tilted. But a sleek, silent trading app feels like a perfectly level playing field. Therefore, the danger hides in plain sight. To understand how the money actually disappears, it helps to follow it out of the account dollar by dollar. The first leak is the one that almost nobody notices, and it is baked into the price of every trade. When a trader buys a stock, they quietly pay the higher asking price, the number known as the ask. When they sell it, they only receive the lower bid price, and that tiny gap is called the spread. That spread is a toll, collected on the way into a position and again on the way back out. For a long-term investor who trades a few times a year, that toll is basically a harmless rounding error. But a day trader might cross that spread dozens or even hundreds of times in a single busy week. So a cost that looks like a few pennies quietly compounds into thousands of lost dollars over a year. And here is the part that stings the most about the modern, so-called commission-free trading apps. Those apps still make their money by selling the trader's orders to giant firms, a practice called payment for order flow. The trader sees a big fat zero sitting in the commission column. Therefore, they assume the whole trade was free, but nothing about it was ever free, because the cost simply moved somewhere they were never taught to look. The second leak comes from the cruel and unforgiving math of trying to win a coin flip over and over. Every trade a day trader makes is a bet against another person who believes the exact opposite thing. On the other side of that trade usually sits a bank, a hedge fund, or a lightning-fast algorithm. These opponents have faster computers, far cheaper costs, and information the retail trader will simply never touch. So the individual is not really matching wits with the market, they are matching wits with hardened professionals. Because of the spread and the fees, a trader has to be right well over half the time just to break even. But the more often someone trades, the more chances that grinding math gets to chip the account down. Picture a trader who is genuinely skilled and manages to win 55% of their individual trades. That sounds like a clear and comfortable edge, and on a whiteboard, it absolutely looks like a winning system. But once the spread, the fees, and the taxes each take their cut, that thin little edge quietly vanishes. So even being right more often than wrong is frequently nowhere near enough to actually come out ahead. There's a famous American study of 66,000 households in their real brokerage accounts. The investors who traded the most earned about 11% a year, while the market itself returned almost 18%. The people who simply sat still and did almost nothing walked away with far more money in the end. That single finding gave the study its perfect and permanent title, Trading is hazardous to your wealth. The third leak is the silent business partner who only ever shows up right after a trader finally wins. That partner is the tax code, and for day traders, it is stacked in an especially punishing way. When an investor holds a stock for over a year, their profit earns a much lower long-term tax rate. But a day trader almost never holds anything that long, sometimes not even for a single afternoon. So nearly every dollar they make is taxed as ordinary income, at rates that can climb toward 37%. Add state taxes on top of all that, and the government can quietly claim a huge slice of every good year. Then comes the rule that catches almost every brand new trader completely off guard. The dreaded wash sale rule. It says that if a trader sells at a loss and rebuys the same stock within 30 days, the loss gets disallowed. So a trader can finish a year down real money, yet still somehow owe taxes on their scattered winning trades. The winners get taxed heavily, while the losers are only partly deductible, capped at just $3,000 a year. Heads, the taxman wins big, and tails, the trader still loses, which is really the whole game in a nutshell. The fourth leak is the largest force of them all, and it lives entirely inside the trader's own head. Human brains were simply never built to make cold, rational money decisions at lightning-fast speed under pressure. Researchers found that individual investors are about 50% more likely to sell a winner than a loser. They snatch tiny profits early out of raw fear, but they cling to losers while praying for a bounce. So their small wins are kept small, while their losses are handed all the room they need to grow. Then there is revenge trading, which tends to show up right after a painful and unexpected loss. The trader feels personally wronged by the market. Therefore, they double their next bet to win it all back fast. But that emotional, oversized bet is usually the exact one that turns a bad day into a genuine disaster. Imagine a trader who is up $200 by 10 in the morning and feeling completely untouchable. By noon, a losing streak has erased it, so they chase harder. And by the closing bell, they are down 1,000. The market did not beat them with some clever move. Their own nervous system did all of the real damage. Fear, greed, boredom, and wounded pride take turns steering that account straight into the ground. And overconfidence quietly convinces almost every single person that they, personally, will be the rare exception. There is one more force in this story, and unlike the slow leaks, it does not drain an account gently. Leverage, usually borrowed through something called margin, lets a trader control far more stock than they truly own. A broker might let someone holding $1,000 place bets worth $4,000, or even more. When the trade finally goes their way, that leverage makes the winnings feel absolutely intoxicating. But leverage is a two-way mirror, and it magnifies the ugly losses just as violently as the gains. A modest move in the wrong direction can wipe out an entire account before lunch is even over. American rules force anyone making 4 or more day trades a week to keep $25,000 on hand. That rule exists precisely because regulators watched countless small accounts get completely vaporized by leverage. Which raises the obvious question: if the odds really are this brutal, why does everyone still think they can win? The answer is a sneaky little trick of human perception that psychologists call survivorship bias. Social media feeds are absolutely flooded with screenshots of enormous, life-changing, single-day trading gains. A trader turns $500 into $15,000 overnight, and the entire internet gets to admire it. But the thousands of people who tried the very same risky move and lost everything post nothing at all. They quietly delete the app, swallow the shame in private, and simply disappear from the timeline forever. So the feed proudly shows off the lottery winners while carefully hiding the mountain of torn up losing tickets. This creates a powerful illusion that consistent profit is common when the actual data screams the exact opposite. The gurus understand this illusion perfectly, and they lean on it to sell the dream even harder every day. They flash their winning trades on camera, stay dead silent about the losing ones, and let hope do the rest. Meanwhile, a small handful of groups make money from day trading with almost total, boring certainty. The brokerages profit from the order flow whether the trader happens to end the day up or down. The exchanges quietly collect their fees on every single trade, no matter who actually wins it. And the gurus selling courses, signals, and private chat groups earn far more from teaching than from real trading. Their true product was never a winning strategy. It was the trader's own hope, sold right back to them monthly. So the reliable profit in this entire ecosystem flows straight to the people who never take the market risk. The trader is not really the player seated at this table. In a very real sense, the trader is the product. Now here is the strange twist that the whole loud industry works incredibly hard to keep quiet. Beating these odds is not actually that difficult. But the honest answer is almost insultingly boring. Buying one simple fund that owns the entire market has historically beaten the vast majority of active traders. It costs almost nothing to run, it triggers barely any taxes, and it demands zero white-knuckle screen time. That same brutal Brazilian study flatly concluded it is virtually impossible to day trade for a living. And decades of research across 3 different continents keep arriving at the exact same tired conclusion. The slow, patient, deeply unexciting path is the one that quietly builds real and lasting wealth over time. The market does reward one thing with remarkable consistency, and that one thing is patience, not frantic activity. Time in the market, as the old investing line goes, quietly beats almost every attempt to time the market. None of this means the stock market is a scam, or that no human being ever profits from trading. A tiny sliver of people truly do win, but no study can reliably predict who they will be beforehand. For nearly everyone else, day trading is less a real career and far more an expensive, adrenaline-soaked hobby. The losses are almost never loud, and that quiet is precisely what makes them so dangerous to ignore. They arrive as a spread here, a tax bill there, and one panic click at the worst possible moment. Death by 1,000 tiny cuts. Each one far too small to notice until the account is simply gone. So the honest takeaway is not that ordinary people should fear the market and bury their cash in the backyard. It is that the fast, thrilling, dopamine-soaked version of investing is the one quietly designed to lose. And yet, tomorrow morning, thousands of these traders will open that very same app, certain that today is finally different. They will believe the losing math somehow does not apply to them, while the invisible house patiently waits to collect.